welcome back to the Millennial Money Mastery. I'm your host, Angel Abundance, the financial physician, with my co-hosts, Alex Garcia, Melissa Uribe. How you guys doing today?
Doing great.
Awesome.
Good. We want to welcome you guys to our show. Today we got something good, something that is going to be really impactful for you guys, and hopefully give you some great information in helping you on your financial journey. So again, we want to remind you guys, this show, Millennial Money Mastery, is all about millennials and their money and trying to help you be a money master so that you can have real great success in your life, understand how money works, how to keep it safe, how to keep it growing, and more importantly, how to make money work for you, okay? Yeah. So today we had a good show. What are we talking about today, Alex?
We are talking about buying a home. First time home buyers, or you're continuing to buy a home.
Yeah. So good stuff. I want to teach you guys a little bit something. Maybe you're thinking about buying a home. Obviously right now it's a really crazy real estate market. Today is September 2nd, 2022. As many of you guys know, the real estate market has been booming over the past 2 years after the COVID fiasco. So you guys know that it's probably really hard right now to buy a home because it's so expensive. And now we have the added issue of high interest rates. So you're trying to get a loan. It's going to cost you a lot more, so you have less purchasing power, basically. And there's a whole reason why the government's doing whatever they need to do to curb inflation, but we're not going to get into that today. One of the things we definitely want to talk about is what are some of the most important things that you need to do when you're thinking about buying a home, right? Mm-hmm. So, Melissa, what do you have to say about that?
I mean, first things first, everybody wants to buy a home. Everybody wants to buy a home. It's definitely somewhere in the image of their future. I mean, that involves us too. I mean, it's definitely in our future. I mean, we're in our early 20s and, we're planning to buy a home eventually, have our family, have our life that we want to pursue and eventually get. But I mean, the question is, when do we start? That's the $1 million question. When do we start? How do we start planning? And the first things first people think is, well, first I need to have money. Obviously, which is the most important thing is the money. You need to start saving. When do I start saving? How much do I start saving? How do I start saving? There's so many more aspects to it than just saving money in a savings account. And a lot of people now, I mean, they go to people that they trust, right? They're going to go to professionals. They're going to go to bankers and ask them, how do I do it? But most importantly is when you start. That's the most important thing, is when you start. And people ask, when do I start? And to put it more simply is now, sooner than later. Definitely the earlier the better is when to start.
Yeah, it's so critical. I think a lot of people have fears about buying a home, or they think they can't, or I'll never be able to buy a home. We live in Southern California. It's super expensive to buy a home here.
Crazy.
But the thing is, you can buy a home, right? You should buy a home, right? For most people, you should buy a home. Maybe not for everybody, but most people should buy a home so that you can, not just throw money away with rent, right? You want to be putting your money into an asset that's growing in value, having some equity and things like that. But I love that fact that you're saying, you have to start now. Wherever you are, you should start now. And especially if that is a goal of your life, you don't want to wait. Hopefully you're making moves to start that process. So that's the first thing we're going to talk about is the most important thing is starting now. And so you need to start planning. You need to have some sort of a plan, some goal of what you're trying to do. And so you need to plan it. You need to make sure that you're doing whatever you need to do, taking even just small baby steps to help you accomplish your goal. So, Alex, what's one of the very first things, and Melissa kind of touched on it, but what's the first thing you should be thinking about when you're planning to buy a home?
First thing, main thing, what Melissa was talking about was a big one, is savings. Saving and really trusting and going to someone that we will actually trust, and a professional, how Melissa was touched that based on, like not even just going to a bank, but going to a professional or maybe a money coach that can help you kind of plan it out and help you with your money, where to put your money, how much to save a month, how much to save here, or what's your goal? How many years are you going to want to buy that house? In 5 years, 10 years, 15 years, and they'll actually go like step by step on how to get and how to achieve your goal. So it's always, you're not on your own. A lot of people think, oh man, they don't think like, oh, like there's people out there that'll just help me, or I have to do this all on my own. I have to do this all with my partner. That's not the case. A lot of people, kind of struggle with that, and I always suggest finding someone or even a friend that's already bought a home and having them help you, start planning and saving, because that is a big like issue a lot of people have when they're trying to buy a home, is they don't know when to start, how Melissa said, but they don't know how to save and completely save, because they might have a goal, but at the end of the goal they have maybe half of what they wanted. And it's always the planning. It's always how am I going to get there, what do I have to do, and how Angel said, take those baby steps. Maybe you don't have $500, $1,000 to save every week or every month. Maybe start slow, maybe $100 here, maybe $100 there, but then slowly kind of increase it, and it'll really help you.
Yeah, absolutely. And it's so critical. So having a plan, talking to someone that can help educate you, having a professional by your side that can give you good counsel and not just trying to take your money, that's super important, right? And as Alex said, you're not alone in this. There are resources out there. There are people who can help you accomplish your goals. And really, just the main important thing is to have a plan, right? Whatever that is, as Alex said, right? Having some sort of a goal and talking to someone that can help you. Okay, what do I need to do? What are the steps I need to take to accomplish that goal by the time that you set? So saving is probably the first step. When it comes to buying a home, you got to be thinking about just putting some money away. I think you hit the nail on the head. Start small, even if it's that $50 a week or $100 a month or whatever it is, but then slowly start to increase. I read a book by Tony Robbins, Money Master the Game, and one of the main things that he talks about in there is this concept of anytime you get some sort of an increase, you get some sort of a raise or whatever it is, don't just go and say, oh, now I can afford more things. Now I can afford that extra, trip, or I can that new bag or whatever it is. Like, no, take that money and just put it away. Pretend like you don't even have it. Or maybe you just take a percentage of that. Maybe it's half of whatever it is that you got. If you got a 3% increase, okay, 1.5 is going to go towards saving. And that's how you slowly start to increase the amount of savings that you're putting away. So I think that's a super great tip. Most people, they get a raise, they get more money, they get a side hustle, they start making extra cash, and they just use it for fun money, and they just go spend it and don't even think more about the future, right?
Yeah.
So. Melissa, what's the next thing as they're thinking about buying a home after, let's say they start to establish good saving habits? What is the next big thing that people need to really consider when they want to buy a home?
Well, I mean, obviously the payment of the house, right? Now they look at a house, the first thing you do is look at the market. Okay, I think I have enough. Now let me go ahead and shop with my partner, see what's out there. Now you have to consider as if you're moving into a new apartment or if you're going to go and rent a home. When it comes to buying a home, however, it's not just the cost of the home, it's more like everything that's going to be involved within it. So you have to think about utility bills, you have to think about taxes, our favorite word, taxes, maintenance, everything that comes into getting the home. And having to secure it, of course, because you worked so hard to save. You worked so hard that you're going to want to protect it. That includes insurance, right? So it's just so much things that comes involved into buying a home that it's really important to consider these things. And sometimes we don't really think about it, which is why it's important to also talk to someone that knows about this information. So that's also something that you need to consider. And of course, that depends on where you live, right? Insurance is going to be different in different places. In California, it's different compared to in other states like Texas, for example, where you have property tax, and you have states that have that have insurances for disasters like hurricanes and having to do with fires, and that's also into consideration where you're buying your home.
Yeah, it's definitely something that you need to consider. Those are all good points. So let's touch a little bit about each one of those things. I think as we're talking about saving and you think about preparing to buy a home, you're gonna probably need to get a loan, right? And when you're thinking about getting a loan, before you go get a loan, probably the first thing that we're gonna do is they're gonna run your credit, right? So if you have credit challenges, right? Maybe you have too much debt, maybe you have some derogatory things on there, some past due medical bills, whatever it is, you need to protect your credit. Anytime you want to buy any type of a thing, whether it's you're buying a car, you're getting any type of a loan or whatever, having good credit is super important. And it's what's going to dictate whether you get better rates or you have to put more down payment or whatever it is. So the way in finance companies, and I've been in the mortgage real estate industry for 20 years, so I have a lot of experience in this, but that's the very first thing that they're going to look at. They're going to look at your credit worthiness. And really what they're assessing is your risk. How risky are you as a consumer, as a client, as a borrower, to take on this debt? If you have way too much debt, then they're going to be like, it's a lot of risk. I don't really want to give this person this loan. Or if I'm going to give it to them, I'm going to charge them a lot and they're going to have to put more money down or whatever it is. So protecting your credit and establishing your credit is super important. If you don't have credit, you're kind of at an advantage because little things you could do could easily increase your credit score very, very fast. If you have bad credit, right, then it's going to take you more work. It's going to be harder for you. But don't fret, because especially if you're on a long time horizon on buying a home, let's say you're 2, 3, maybe 4, 5 years out, that's plenty of time for you to start to work on your credit while you're saving, while you're doing all the other things. But this is super important. It's like the number one most important thing. Now, there are people out there who say, you know what, you shouldn't, don't worry about your credit, just get out of debt and don't even worry about a credit score. You can do manual underwriting and things like that. Let's say the Dave Ramsey camp. But I think that's a little unrealistic. Almost everybody who buys a home is going to have to get a loan. And it's much easier if you do it with some good credit history and good established credit habits. So let's talk a little bit about credit, because I think a lot of people have a misunderstanding of how credit works, what dictates your credit score and things like that. So if you guys will let me talk a little bit about that. So one of the things that impacts your credit score the most is your payment history. That is probably the number one biggest thing. And if you go to FICO's website, and FICO is the Fair Isaac scoring system, basically, that's what establishes your FICO score. And that's what the credit companies and lenders and banks, whatever, use, right, to determine, whether you're a good borrower or not, or what rate you're going to get. But and from FICO's own website, it basically says that the things that impact your score the most is your credit or your payment history, the amount of credit to debt, or the amount of debt to credit, I should say. So the lower percentage of debt to credit, then the better score you're going to have. So if you have, let's say, $10,000 of a credit line, but you only owe, let's say, $1,000, then you have a 10% debt to credit ratio. So that's going to be much better than someone who has, let's say, $5,000 of debt. So now you have 50% of credit debt to credit ratio. So your score is going to be much lower because you have more risk. Right? You've used up 50% of the credit that you have. So there's definitely things that you can do to help prevent that. Number one, pay off your credit every month if you can. Right? If you use the card, pay off. Like, don't even, if you do that, you know that you actually can borrow money free. Like you can use that money free for those few weeks. If you pay off that credit by the end of the month before the bill becomes due, then you're going to be in a much better spot, because the companies are going to show that, okay, this person knows how to use credit. They're being responsible. They use it, but then they pay it off. They don't carry a balance every month. So that's a super, super important tip for you guys. If you really want to use credit, you have to learn how to be responsible with it.
Yeah. Definitely don't use too much of it either.
Yeah, no, and a lot of people, they look at it, and especially like when you get into college, one of the first things you do is, sign up for credit cards and you get a free t-shirt. It's like, okay, so they get this money and people like just use it as a piggy bank. They just start swiping the card, buying whatever, going out to eat, partying, whatever, and then later on the bills come. And there goes all your paycheck because it's going to credit.
Yeah, that's... I'm actually in... I actually did that when I went to college. I got like my first credit card was Wells Fargo, and I got a credit card with them, and I think I got it approved for like $1,000. No, it was like $1,000 or $1,500, and I was like, oh man, and I didn't view it as, as how Angel would say, like, use it as credit, like you buy it and you pay it off. I didn't see it as that. I saw it as that I'm $1,000 or $1,500 richer. So I got that's my money. I basically saw it as it was like if it was in my bank account, like it was my debit card. I'm using my debit card. I got $1,500. I'm good to use, and then I'll just pay what I'll do is I'll just pay the minimum. I'll just pay if I use $1,000, the minimum payment is like $50. I'm like, oh, $50, okay, and I'll just pay it off, and I'm like, oh, I'm good, and a lot of people, I feel like a lot of young people our age, they think of credit cards like that. They think of, okay, I got more money now, I can use it now, and I only have to pay a minimum payment every month. Like, no, it's like credit utilization is a really key and big thing for your credit score, and I didn't find that out till I was like like 21, 22 was when I was like, okay, I was using like more than like 60-70% of my credit cards, and I was like, okay, no, I gotta stop.
But the good thing is you realized it young. There's people that like me that didn't realize that till I was in my 30s and stuff. So you're ahead of the curve. In fact, I think you're probably ahead of the vast majority of Americans that don't see it that way. They see it the way you did, right? Where it's just, hey, it's free money. One of the things that people don't understand is that is the way that a lot of people, or that's the way that we contribute to inflation, because they basically are printing money in a lot of ways, right? They're giving you credit, this, like opportunity to spend money, and that it just creates more dollars in the economy, that it rises, costs rise because of it, and that increases inflation. So utilizing credit that way and just spending money like crazy is a way that contributes to inflation, which is one of the reasons why we have a lot of financial problems right now. I mean, what is I think our country just has a really bad relationship with credit. If you look at, our national debt right now, I mean, we're at $30 trillion or something like that. $30 trillion with the T. So you guys need to understand, like, our country in itself just doesn't have great money habits. We do a very poor job of managing our credit, managing our debt, and it's contributed to a lot of problems, the financial problems that we have right now. So you can do your part by being a wise financial steward and just learning how to manage your money and making sure that you're not utilizing debt in those type of bad ways. I think there is good debt and bad debt. Some people might say it's all bad debt, but I don't think buying a home is bad debt, right? You're actually buying an asset that's going up in value. So I wouldn't call that a bad debt. I think if you buy just stupid stuff, liabilities, things that go down in value, like let's face it, a car, or buy that fancy sound system or whatever it is, that's just a liability. It's not tied to anything that's going up in value, right? So if you are going to spend credit on stuff, make sure it's an asset that can continue to grow, and use it as such. So let's talk a little bit about a couple of other things when you want to buy a home. So number one, protect your credit, establish good credit, pay things off on time. Again, getting into some of the things that impact your credit utilization, your credit debt, basically your debt to credit ratio, how old your accounts are. So if you have a bunch of new accounts that you just opened up, that's going to impact your score negatively. You're going to have a lower credit score until you have an average age that is longer than 3 to 4 years. Once you have, what that shows is basically that you can manage debt over the long term. So they want to see good payment history for a long period of time. And the other thing too is you want to have different types of credit, secure debt versus unsecured debt, like a car or a home, right? There's an asset that's tied to it, that's a secure debt, versus a credit card that's just an open revolving line of credit. There's really nothing tied to that, right? So that's unsecured debt, right? So secure debt versus unsecured debt. Personal loans would be like unsecured debt. So having secure debt versus unsecured debt also helps. When the moment that you buy a home, actually the credit companies and the lenders and stuff look at that favorably, because now you have this big, large asset that you're managing, you're taking care of. They want to see that you're making those payments consistently over a long period of time. That will also boost your credit score. And then one of the last things that impacts your credit score is, let's see, so your debt, age. So types of credit. There's one other thing I can't remember off the top of my head, but you can go to Fair Isaac, the company Fair Isaac, the FICO score company basically, and you can look up all the things that impact your credit. So number one thing, save. Number two, establish good credit. And then number three is your income, right? So you want to have a good amount of income. This is one of the things that they look at. They look at your debt to income score. So if you have credit, you have credit obligations, car payments, credit cards, whatever it is, what they're going to look at is, of the gross income that you have, how much of that is going towards credit, towards payments that you have to make. You're obligated to make those payments. So the higher credit or payment that you have every month, right, the higher debt to income, and that will make you more risky and you could potentially not qualify. So a good rule of thumb is 32%. 32% debt to income ratio is like the good baseline for you to have. If it can be lower, even better. And then the other thing that they look at is other things like all your other bills. right? All your other bills, they'll take into account, and they'll look at it from the back end. It's called your back end DTI. DTI stands for debt to income. So if you're above 50% with all your bills and everything else, then you're kind of more risky. So they may deny you for that. So you want to keep your total payments and everything else under, let's say, 45% in total. So if you don't make enough money to, let's say, afford the payment, let's say if you buy a $500,000 house, maybe your payment might be like $3,000 a month or something like that. But let's say you only make, $6,000. Well, you're like a 50% debt to income ratio. So maybe you need to make more money, either reduce some of the debt that you have or make more money. So definitely something you want to consider. Anything to add to that, Melissa?
As to the income,
Yeah.
I mean, I think it all just comes into budgeting. I mean, like you said, we've come to a culture where we just consume, right? We get raises and we love to spend, and we don't think about the future. So when it comes to this, it's really important to really budget. Know where your money is going. Know how much you're going to be saving. Know the importance of what you're going to buy. There's definitely way more tactics that you can use to budget, like making a budgeted plan. Get together with your partner and really think about what you guys are going to put your money in, what you're going to cut out. I mean, I think it's worth it. I mean, not going to go out to eat a couple times a month just so you can get your house, something that's going to grow in value. I mean, how long does a plate of steak cost compared to a home, right? So you got to really think about the bigger picture when it comes to your income. What's really important? What's your value? What's going to really benefit you both when it comes to that, for sure.
Yeah, I love that because it's so true. I think, any good financial strategy for your life, whether you're saving for retirement or buying a home, whatever, I mean, those are super critical. And we kind of touched on a little bit about budgeting is so, so important. And really, you got to look at it like if you want to accomplish a goal, it's going to take some sacrifice. It's going to take some hard work, whatever it is, right? You want to lose weight, guess what? You have to go to the gym. You have to eat healthy.
Yeah.
You're going to have to sacrifice some things. You can't go eat a cheeseburger and pizza every day,
Yeah.
right? So it's the same thing with your finances. You have to be financially fit. You have to watch what you spend. You have to, just like you watch what you eat, you have to watch what you spend and make sure you're not just spending money on stupid stuff and just buying the latest gadgets or the nicest clothes or whatever else. It's like, no, I'm going to sacrifice right now. I don't need anything new. I'm good, but I'm going to use that money to save it, to put it away for the future, for some goal, whatever it is.
Yes. You don't need to upgrade all the time. So don't worry about upgrading your phone, upgrading your car. I mean, take advantage of the more income that you have and really save it for something worthwhile in the future.
Yeah, right now I'd say I'm like on a 3-year phone upgrade. Like I don't do it every year, right? Even though there's a new phone coming out every year. The Apple's new phone comes out next Tuesday or something like that, right? So, but you don't need to buy it. You don't need it. Your phone probably still works just as fine. It's just like, they have great marketing that hypes you up and you're like, oh, I got to have it. They make you feel like you're going to FOMO, right? So you have to have that self-control. You have to learn to establish those good money habits and learn to say no to yourself, because it's for a better something better in the future.
Definitely hard. It's going to be difficult, obviously. I mean, anything good comes with difficulty and sacrifices. It's just how bad do you really want it?
Yeah, that's key. How bad do you want it? How bad do you really want to buy a house?
Yeah.
If you really want it, then you know what? You're going to save. You're going to invest money. You're going to have good credit. Right? You're going to establish good money habits. You're going to protect your income. Right? Your number one wealth building tool is your income. We had a video about that. In fact, when we talked about saving last show, we had a show about the best places to save money. So, we'll put a link up here. You can maybe click on that, watch that video. Best places to put your money away. So when you talk about saving, where do I save? Watch that video, give you some good tips. Now, once you have money saved, you have credit, you're good, you have the income, right? Now you're getting ready to buy a home. One of the main things you're going to need to consider is the down payment, right? So you need to know the cost of the home. You need to have a general understanding. So you want to maybe work with a broker, a mortgage broker that can help walk you through the process. And the reason why I say work with a broker versus, let's say, a direct lender or going to your bank even, is that brokers can shop around. They can find the best deals. They can find, they work with many different lenders, and they can give you many different options and tailor a plan, a loan that's perfect for you. So that's definitely one of the first things. Find professionals. You mentioned earlier, professionals can be your best friends. They can be your worst enemies if you don't find someone that has a good heart that's going to educate you and not just try to take your money. But finding a good mortgage broker will be important. And then they'll help you structure and they'll help you determine, get you a pre-qualification so you know about how much you could potentially afford based on your income and things like that. So then you have an idea of how much house you can actually afford.
Yeah.
Right. And then the next key point to that is down payment. You have to know about how much you're going to be able to save up to put down, and not just the down payment, but also closing costs. Whenever you get a loan, there's going to be fees that you have to pay. You have to pay for the appraisal. You have to pay for other things. So you're going to have closing costs. So it's not just the money that you put down for the down payment, but then there's other fees, closing costs to actually finalize the loan. So when it comes to putting down a down payment, do you guys know what's the good rule of thumb for the amount that you want to put down?
So what I've heard for first-time home buyers, they say at least a 20% down for a house, just so you can, because when you put a bigger down payment, it actually helps you with your loan. It actually helps you get approved for maybe even a bigger loan if you want maybe a bigger home, or it's going to cost a little bit more. A bigger down payment actually helps you with your loan, but I've heard rule of thumb, I've heard 20%.
Yeah,
is like the you hit it right on the spot.
Yeah, I would say that's the goal that everyone should try to get to. If you can do more, great. But while 20% is a great target to have, you can get away with putting down less, right? We'll talk about that right now. But let me tell you guys, in case you don't know, 20%. Why 20%? 20% gives the lender some confidence that you have less risk, right? Because you're bringing in 20% of the value of the home, and you're going to put that down. You're going to give it to them, or for the sale of the home, basically, not to them. But then they're going to have now only have to borrow or lend you 80% of the value. So what does that mean? That means that you have a good 20% of equity. So if the value of the houses drop, right? Like in 2008, they dropped anywhere from 40 to 50%, depending on your market. It may have been less, but it may have been more. So a lender then is going to look at that and say, okay, well, that's less risk, because if the market does tank, well, at least I got 20% wiggle room in there. It's less likely that he's going to walk away from the home if he's upside down. So that's why you're going to get a better rate. And also super critical is that they will not require what they call PMI, private mortgage insurance. If you have a loan that's less than 80% a loan to value, then you are going to be required to have PMI, private mortgage insurance. And that just adds to the cost, your monthly cost, that you may not want to deal with. So having that 20% eliminates the need for private mortgage insurance. Now, you can put down less, right? You can put down 10%, you can put down 15%, and you can put down 5%. You could even put down as low as 3.5%. In some cases, you can get even 100% financing. Yep. I do not recommend 100% financing. Okay, why? Because for that same reason, you have no equity in the home. You have no wiggle room. So I would say try to avoid going 100% down just right off the bat. Like even if you get a combination, what they call a piggyback loan, let's say you get a big first for 80%, and then you get another one for 20%, another loan. You don't want to do things like that. The other thing is there's a bunch of different programs out there. There are different cities might have some programs to help with down payment assistance. The state might have some down payment assistance. And these will usually have with some stipulations, like you have to live in the home for 5 years, or if you sell it, it has to be to someone else within the city, blah, 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 different things like that. But for most people, you might have heard this, they'll get FHA financing. FHA financing is basically the Federal Housing Administration. It's basically the government guaranteeing the loan for the lender. Like if you default on the loan, if you stop paying, then FHA, the government will say, hey, we'll still back you up and we'll pay off the loan if the person defaults. And with those loans, you can get away with 3.5% down payment. Okay, so let's do some numbers really quick. If you have, if you're going to get a $500,000 house, if you put 20% down, how much is that?
Like 20 grand. I mean, 20 grand, 100 grand.
100 grand.
Oh, 20 grand.
Yeah, wish it would be 20 grand. So $100,000, right? I mean, who can save up $100,000, right? It might take you a long time to do that, right? So that's where people are like, man, how am I supposed to do that? Now, for us in California, I mean, average home prices around here around 600,000, 635,000. So, putting 20% down is probably going to be really, really tough, especially for a first-time home buyer, unless you have maybe family or someone that can help you out. But 3.5%, is only like $18,000, right? So that is much
It's a little
easier,
more, yeah.
Yeah.
much easier to do than $100,000. So, but when you put down that 3.5% with FHA, FHA has mortgage insurance built into it. You're gonna still have to pay for that mortgage insurance. So that's definitely something. But at least you'll be able to buy a house and you can start, instead of wasting money on rent, you start building some equity.
Yep.
Better.
What do you right now? Let's say for where you guys live, how much is a typical rent for, let's say, a 3-bedroom apartment or condo or something,
condo.
or house even?
So for apartments, right now in our area, it actually went up. So we got lucky. Our rent was actually pretty low, but it got shot up to like 2,700. About 2,700, and that's for a 2-bedroom, 2-bath. Not even a 3-bedroom, but 2,700. And a 1-bedroom is like 2,100. So if you're living on your own, like that's tough. 2,100 a month, that's really tough. And that's not including like you got to pay electricity, gas, and that's just base rent. Yeah, so it's tough out here, especially in California. It's super expensive. Right now it's just everything's just going up, and apartments there's really a line. Like a lot of people are like in line just to rent apartments because a lot of people can't afford buying houses. I feel like a lot of
renting
people,
a house even.
Yeah, renting a house. A lot of people are more moving into apartments, and it's not just like just 1-2 people. There's like groups like going like 4 or 5 people into 1-bedroom, 2-bedroom house because it's so expensive, and then they have to group up just to split the rent just so they can afford it.
So I asked the question because a lot of people don't really think about what the long-term cost is of renting. So let's just say you're paying $3,000 for let's say for a 3-bedroom. That's probably good luck finding that here in Southern California anyway. But let's just say $3,000. Okay, at the end of the year is $36,000. Right? $36,000. Now let's say you rent for a few years. You rent for 3 years, right? You're over $100,000.
Yeah.
That's over $100,000 that you could have been putting in to a house, right? Your own house, building up your equity, paying down that loan. The values are going up, so you could eventually have a good amount of equity in a home by doing that. So you really got to do the math. Like, okay, I'm renting for X amount, 2,700, 2,000, whatever it is. No matter where you are, you can do the math and figure out, okay, if I live renting for 5 years, how much money is that going to be? How much better off would I be in 5 years if I was actually buying a home? Maybe it's not the perfect home. Maybe it's not your dream home, but maybe it's just a starter home, right? You said early on, start now. Maybe you start now with something small. Maybe you buy a 1-bedroom condo or a 2-bedroom condo or something. Maybe it's not even a house, right? And yeah, it sucks. You don't have freedom. You don't got a yard or whatever, but at least you're putting money away into an asset that's growing in value. Yeah. And then you slowly upgrade over time. Maybe after 3, 5, 7 years, you've built up some equity in it, and now you can sell that home and then use you have more money to put towards a down payment on a bigger house, right? Mm-hmm. And you slowly upgrade over time. No one starts out buying their dream house. I mean, let's be honest. You have to start small and slowly work your way up. So I think that's really important when you think about that. As you're thinking about buying a home, do the math. Figure out like why should you buy a home? Because I'm wasting all this money is probably a good reason. But also then to give yourself a better quality of life and start to establish a good financial, like empire, let's call it. Being one of the biggest assets you might buy is a home. So definitely something to think about. Mm-hmm. Now, Melissa, you talked a little bit about insurance. Let's talk a little bit more about that because I think a lot of people, think that, I once you get the house, I just have to buy homeowners insurance. But we live in California. Mm-hmm. What is the biggest problem that we have right now, weather-wise or disaster-wise for us?
For weather-wise?
For California, yeah. What's something that probably California homeowners need to be thinking about as far as insurance goes?
Honestly, I'm not sure, Angel. I'm not sure.
Fire.
Fire.
Fire?
Yeah,
We're the fire. Number 1 for fire?
Fire. We're California. All the fires.
Yeah.
Okay.
Okay.
I'm like,
let's try that again. Okay. So, Melissa, you talked about insurance, right? One of the things that a lot of people need to consider is that it's not just, let's say, the homeowner's insurance, but there are maybe things that you need to consider for your home specifically in your area. So for us that live in California, what is one of the biggest things that we need to consider now when we talk about our homes?
Yeah, definitely insurance for fire disasters. I mean, it's happened before already. You've seen it in the news. I'm pretty sure everybody's seen it in the news where people actually get evacuated from their homes due to fires. And some people actually lost their homes. And imagine if they didn't have any type of insurance that came involved with that. I mean, they had to struggle and pretty much start over. So it's really important to have some type of insurance, especially depending on your area. I mean, I think you mentioned before too, you actually had to get evacuated from your neighborhood.
We got evacuated in 2020. We're here in Southern California in Irvine, and we never thought, but we do live next to some hills here next to the Cleveland National Forest, and sure enough, it was a big fire, and we got evacuated, and the fire was less than 1/10 of a mile from our house, so it got close.
Yeah,
It got close.
you never know. You might think
Exactly.
you're good. I'm not gonna need it. We're okay. But I mean, when it comes to buying a home, that's stuff you have to consider. It's better to have it when you need it than to not have it and you actually really need it. So that's pretty important to have and consider. I mean, especially with the cost. So definitely look around your area. What kind of insurances you're going to need, how much is it going to cost, and definitely include that when you're going to be saving.
Yeah, thinking about, especially when you think about what your monthly payment is going to be, what you can actually afford. You got to take those things into consideration. But let's say you don't live in California. Maybe you live in a place that's in a flood zone. You're going to be required to have flood insurance. Or if you're in Florida or something, you might need hurricane insurance.
Oh, yeah.
Or let's say California, we might need earthquake insurance, right? So be thinking about those things too, depending on where you live or where you want to live, that those are other things that you're going to need to have. And it's really important because, being in the real estate industry for a long time, we saw where people wouldn't have even adequate coverage. Let's say they bought the home in 1980 and the home was 200,000, right? And they've had their same coverage and they have the same policy and whatever. And then the values have gone up and now the home is worth more like 500,000 or something. But then the house burns down. Well, your insurance policy was only for 200,000. Right. So you may not have adequate coverage. And so you need to be thinking about that as you start to, being a homeowner and you have, let's say equity is going up. Like right now, values have skyrocketed. Maybe now is a time that you need to consider, upping your coverage, because the last thing you want is to lose money and, and not have sufficient coverage to cover whatever the cost is to rebuild a home. Let's take the example of the Camp Fire, I think in 2021 or 2020, that city Paradise, California, where like 95 or even more percent of the entire city was completely burned down.
Yeah.
If you go today, there's still a bunch of homes that weren't rebuilt. And one of the reasons why is because they didn't have adequate insurance, and FEMA only gives you so much. So you really got to consider that. And we're talking about this because we want to make sure people understand that it's not just about buying the home. It's about what it takes to maintain a home.
Yeah, definitely protect it.
Exactly. This could be one of the most expensive assets that you buy or that you invest in. You want to make sure that you're protecting it and thinking about, the long-term maintenance of it. Because it's not just, hey, I bought the house. Okay, great. Well, if you've been renting, what happens when something breaks down? You just call the landlord. Hey, come fix this thing. The water heater broke. And the landlord will show up and fix it.
Yeah.
But when you own the home, who are you going to call? Hello, landlord? Yeah, that's yourself. Basically, there's no landlord there. It's you. So you're gonna have to, now take care of all those things, right? Keep up with the maintenance, painting, plumbing, all that kind of stuff. Yeah. The other thing too is taxes, right? You touched base on that, Melissa.
Oh yes, taxes. Everyone's favorite word.
Oh God, yeah, taxes. But something to consider, right? Because let's say certain areas is gonna be a lot more expensive in taxes. Let's take some place like Texas, right? There's no state income tax, right? Lower cost of living, depending on where you are, but super high property taxes, right? So, okay, yeah, you get a bigger home, but you're also going to be paying more for it to maintain it every year. Here in California, we have some pretty high property taxes as well, but maybe in your state it's not that bad, So maybe if you're willing to move to another state that's lower cost, be considering that. Maybe staying where the state you're in is not the best place to buy a home initially. Maybe you got to move somewhere else.
Yeah.
Yep.
And just, too, like, it may even be different from city to city or county to county. So maybe if you need to go down the street a few miles to have a lower sales tax or lower income tax, or not income tax, but property tax, maybe that's something you need to consider too.
Yeah.
Yep. It's a big thing,
So Alex, one of the things that Melissa mentioned early is these professionals She mentioned like a financial advisor. We talked about maybe having a mortgage broker. What are some of the other types of financial professionals that you may want to consider having in your corner?
Pretty big one would be maybe a money coach, or as we have here, like yourself, like Angel. Angel here is actually a financial, he's actually a
Coach, yeah, that's what I do.
financial coach, and he'll help you. He's helped us a lot. Help you guys, try to get to your goal to achieve what you need. And maybe even just how I said earlier, maybe just a friend that you've actually had that bought a home before, that's already bought a home. They can maybe give you some tips, get some help, give you just a little help, because a lot of people don't have money to buy a financial advisor. And so most of the time, or a lot of the times, I've heard that a bunch of people spend so much money on these financial advisors, but what they originally just do is just take your money and they're like, okay, this is where you're gonna put your money, but they don't really show you step by step what you're gonna do or what's gonna help you. They kind of just said, okay, we're gonna help you. We did this, and that's it. And it's not really like, you don't really learn from that, and you're spending all this money, but you yourself don't really know. Because what if you want to buy a second home or a third home? What are you gonna do then? Are you gonna buy another financial advisor, or what if you do it on your own? It's a lot easier, and you save a lot more money doing it that way.
Yeah, no, for sure. And I appreciate you talking about that. I am a financial coach, certified financial coach. I mean, this is what I do, is try to help people with this. And we kind of talk about that, right? Having a plan. That's a lot of what I do, is just help people understand, how to achieve their goals, right? So buying a home is a goal, or maybe buying multiple homes, right? How can you do it? Here's a step. Hey, buy this home this way. Then you do a little bit of this, do a little bit of that, and now you can buy your second home, now you can buy your third home. But that's super important to do that, especially if you don't have someone around you that really understands finances. I would be careful going to just your brother-in-law for financial advice. Just be careful, because a lot of times they have good intentions, they want to help, but they may not know everything, right? They may have not studied, they may have not really had the full education of finances and the money game and everything else. So just be careful out there, but find someone that can educate you. Find someone that has the heart of a teacher, who's really going to explain to you why, not just say, hey, do this. It's like, no, okay, you're doing this because of X, Y, and Z, but here are some other options, and this is why I'm recommending this one or whatever. These are the risks associated with all these different options. Make a decision. This is what I recommend. Here's your choices. So that's what you want, right? You want someone that's actually going to help you and educate you, not just take your money.
Yep.
Yeah.
Mm-hmm.
Someone else too is a good realtor. Really, really, really important. Okay. Just because your cousin has a real estate license doesn't mean that they're the realtor you need to go to. Okay. I'll be the first one to admit. You want to find a realtor that knows the market, that's been in the industry a while, that has a good reputation, that has plenty of transactions under their belt, so that they understand really how things work. They know how to price things. They know how to negotiate. They know what the entire process is, that can really walk you through step by step. So that's super critical. I know our company, one of the things that we're doing is we have a real estate firm now, and we're encouraging, our financial folks to get their real estate license as well, so that, they can help more people, because we see people get taken advantage of all the time, or their realtor just doesn't know what they're doing. So very important. Lastly, I would say is get a tax person. Have a tax person that really understands taxes all the way around, a good CPA or whatever, someone that can teach you, because real estate can be a great way to, kind of limit your taxes. And you want someone that can kind of teach you, okay, well, if you do this strategy, you can eliminate your taxes this way, or you can reduce your taxes here, or hey, do it this way, structure these things this way, structure your company this way, or whatever, and they'll help you try to minimize and reduce the amount of taxes that you have to pay. Yeah. I want to go back to the first thing that you said, Melissa, is start early. Right? So start early. Mm-hmm. This show is all about for millennials, right? Millennial Money Mastery. One of the things that I really want to just drive the point home is that you can start right now. Doesn't matter if you're 18, doesn't matter if you're 49, 39, whatever, but start early, start now, do something, because property values could continue to go up. I personally think they could go down. I think that one of the key important things is also timing, right? When you buy a home, I would say maybe right now we have this bubble. Maybe right now is not a good time, but right now is a good time to be saving and planning for when the market has a correction, and then you can pounce, right? And if you have the money saved up And if you have good credit and you have the income, then you're going to be ready to strike and take on a good deal. And, you might be in a way better position than other buyers. So, be ready, be ready to go, because you never know when that right opportunity might pop up. Maybe your, old uncle says, hey, I want to cash out. I'm moving out of state. I'm willing to sell you the house. And, if you're ready to go, you can be like, yeah, great. I get this great deal or something. But if you're not ready and you don't have the credit, you don't have the savings, then you can miss out on a huge opportunity.
Yeah.
What are some other things, any last tips that you guys want to give about buying a home?
Okay, and then another tip I have for you guys is just if you guys are worried about how right now in California interest rates are really high right now, 5-6%.
Everywhere it's high.
Or everywhere, yeah. You don't really have to worry about interest rates right now. Buy your home, and later on down the road, interest rates might go down. You can refinance your home and actually get a lower interest rate. So don't always worry about the interest rate that's on at the market right now. You can always refinance and get a lower interest rate later on in the years. And it can help you out, and maybe you can even buy a second home when you refinance it. So that's a really good way. So just don't think about interest rates too much when you're buying a home. But
keyword is equity for sure. Once you have that equity and you have that ownership of a home, it really opens more opportunities for you, whether it be to get a second home or even think about buying even a third home, and getting that income. And that's when you really start to realize, like, wow, like, good thing I started early. Good thing I watched that video, because you never know what doors can open for you if you just start now. Like, be ahead of the game. Thank yourself later in the future, like, wow, you know what? Good thing I started early. Good thing I started saving and I took this seriously. And you'll see in the future how much your life can change with just that little step.
Yeah, absolutely. And, who knows, maybe in the future, 5-10 years from now, you guys are going to be like, what was that one video that I watched, that Millennial Mastery? Hey, feel free to send us an email or send us a message, DM us, whatever, which all our contact information is down below. I should probably post that here. You can reach us, wherever, social media is found. And let us know. Or maybe if this video, inspired you to start taking some action, we would love to hear that. We would love to know how you're making changes in your life and how these types of videos are helping you in your financial life. So remember, have a plan. Start early. Start now. Don't wait. Don't have to worry about your dream home. Have a starter home and slowly start working your way up. But, learn to love saving, learn to, take care of your credit, but, increase your income and be thinking about the future, because that's how you build long-term wealth is really just having consistent small steps, and that later on will, multiply and turn into a big, massive heap of cash probably. So.
Yeah, you never know.
So cool. So, hey guys, we really appreciate you watching, and we want to invite you back. We're always going to be having more and more content. Find us on all the social medias. You can DM us if you want opportunities on how to make money, or you want some help, you want some financial coaching. We have that. We got debt courses, we have crypto courses, things like that. But we really appreciate you guys. We love you out there. You guys are the best audience. Take care, everybody.